Hello everyone, Dolf de Roos here. Welcome to my podcast. Today I happen to be in Chicago. In fact, I'm on the 16th floor of this grandiose building. I would have the camera set on the view that I'm facing right now, except the only thing is with me being in a window, I'd be completely silhouetted. You might argue that I'd look better as a silhouette. But my point is I really love this view. Chicago is an astounding city. It is second only in its grandeur of commercial buildings, in my view, to New York City. And maybe at the end, I'll take the camera around and show you the view that I've got here. But it truly is spectacular, and it makes you realize how big and vast the commercial real estate market is. We are here today to talk about aspects of financing commercial real estate. And let me start off by saying that it kind of goes without saying that if you're in the market to buy commercial real estate, your job will be much easier if you have 20 million in the bank than if you don't. So obviously it's easier. However, I would say this, if you did have 20 million in the bank, I wouldn't recommend that you go out to buy a $20 million portfolio, because that would not be good use of your money. I think if you did have 20 million in the bank, you should buy a 40 or $50 million portfolio. See if you can stretch it to 100 million, because you've got the benefit when you invest in real estate of leverage. And why not leverage your capital in commercial real estate as well? So that if you bought, say, a $40 million portfolio with your 20 million cash and real estate values doubled, then you would go from 40 to 80 million, still with 20 million of debt, of course, but your net worth would have gone up to 60 million from your initial 20. You would have tripled your equity. Whereas if you just invested the $20 million cash to buy 20 million of real estate and it doubled, it would have gone to 40, you would only have doubled it. That's the advantage of leverage. You get that in real estate, and you get it with very few other investment vehicles. It is very difficult to borrow money to buy stocks or bonds or unit trusts or certificates of deposit or options or futures. But with real estate, banks all over the world advertise on billboards and newspapers, where they still have them. But online, they say, do you want to buy some real estate? Come and see us. We will give you the money to enable you to do so. They mightn't use those words exactly, but that's the essence of what they're offering. So, easier to buy commercial real estate if you've got a lot of money. This program is not really for those people. This program is for people who perhaps don't have much money, and even some people who don't have any money, but still want to get into commercial real estate. And your first question might be, well, surely it's absolutely impossible to buy a skyscraper like I'm sitting in today if you don't have any money. And the truth is, it probably is pretty difficult to buy a skyscraper, but there's nothing to stop you buying commercial real estate. In fact, I would go on to argue that it's probably easier to buy commercial real estate if you have no money than to buy residential real estate if you have no money. And to understand why that is so, we've really got to go into a few aspects of what makes commercial real estate different from residential real estate. So to lay the groundwork for this, I want to start off by pointing out what I think is the difference between residential real estate and commercial real estate. And this may seem totally obvious to you, but we'll come to an aspect of what is considered commercial real estate that really baffles me. So my definition of residential real estate is that it's real estate where people have residences. It's where they live. Single-family homes, apartments, condos, multifamily buildings, duplexes, triplexes, tenplexes, whatever. That's all residential because it's where people have residences. And commercial real estate is real estate essentially where people conduct commerce. It's some kind of business-related activity. It could be a retail store, it could be an office, it could be a storage facility, it could be an airport or a hospital, or any of a number of things like that. And you probably think, well, that's pretty obvious. Why do you mention that? And that is because for some reason, in this country in particular, in the United States, for both mortgaging purposes and financing purposes and appraisal purposes, multifamily apartment buildings are considered commercial real estate. And in my mind, they're not. They're residential. They're just large-scale residential. Instead of having one tenant, the way you might have in a house, you might have 12 tenants in a 12-plex or 200 tenants in a 200-plex, if that's a word, but an apartment building with 200 units in it. And you're still bound by all the restrictions and covenants of the local residential tenancy rules and regulations. And your tenants still tend to sign up for a residential tenancy agreement, whereas your commercial tenants tend to sign up on a commercial lease. And you might say, is there even a difference? And there is, and there are many differences. We could spend many sessions talking about just the differences between commercial and residential. Maybe we should do that at some stage. I just want to summarize them here because I really want to focus on commercial financing. But one of the fundamental differences between residential and commercial real estate is that residential real estate is very people-centric. You tend to deal a lot with people. Now, to be sure, there are contracts involved, such as what I mentioned a moment ago, the residential tenancy agreement. But in essence, you're dealing with people, and you'll often get called by a tenant who might say something like, hey, come and fix my toilet, it's blocked. And you'll say, what on earth are you doing to block it? That's the third time this month you've blocked it. And you'll say, none of your business, get a plumber. So you call the plumber and he says, how about 4 p.m. on Wednesday? And you ask the tenant and they say, no, that doesn't work. How about 10 a.m. on Thursday? And you call the plumber and you're back and forth and you're essentially dealing with people. And I know some of you are saying, but hang on a minute, Dolf, why would you manage your own properties? Surely you would get in a property manager. And the answer is to that, of course, well, yes, you would, but now you're dealing with the property manager. It's a human interaction between you and the property manager, and you have to make sure that he's looking after these things to your satisfaction, because as in any sector of our economy and life in general, you've got people who are good at something and people who are mediocre, and you want to make sure you're dealing with the good people. Whereas commercial real estate, on the other hand, is essentially dealing with contracts. You've got a commercial lease agreement, and that stipulates just about everything about the interaction between you, the landlord, and the tenant, who is the lessee. And you might say, well, surely there are people involved. Of course there are. There are the tenants themselves. There might be the leasing agent that you're dealing with. There are the tradesmen that you might engage to fix certain things. But firstly, most of the things are repaired by the tenants, because most commercial leases say that the tenant shall maintain the premises in exactly the same condition as they were when they took on the premises, except, of course, for normal wear and tear. So if there's a bit of wear on the carpet, they don't have to replace it. But generally it means that if the faucet stops working, or the toilet is blocked for that matter, they tend to get that fixed because they were working when they took the premises on, and so they go out and get them fixed. And usually they prefer to do it themselves anyway. They're in the commercial arena of business, and they'd rather call the plumber and negotiate with them directly than go through a third party, namely you. So residential property tends to deal with people. It's very people-centric. Commercial real estate tends to deal with contracts, and things are stipulated in that contract. There are, of course, a number of other benefits. I'll just name a couple of them. With residential leases, they tend to last about a year. And in my experience, some of them, when the year is over, you sign up for another year, but often they just automatically go month to month. Whereas commercial leases tend to last multiple years. In days gone by, they used to be a lot longer than they are now. They'd be easily 10 or 15 years. In the city of London, they tended to be 25-year leases. And now they're a bit shorter, but even so, you'll often get a 5 or 6 year lease. And the most frequent call I get from my commercial tenants is, can I please get an extension on the lease? And they might ask for a 5-year extension, and I'll look it up and I'll say, but hang on a minute, you've still got 4 years to run. And they say, yes, we know. But anyway, getting back to the question, can we please get a 5-year extension on the lease? And you've got to ask yourself, why do they want a 5-year extension on the lease when they've still got 4 years to run? And typically it's because their clients know where the business is. The clients just drive to the business. They don't memorize the address or look the address up on some app. They just tend to just go to where they know the premises are. So there's a goodwill factor. They don't want to change the cost of moving, especially for a tenant like a medical practice where they might have MRI machines, or a dentist practice where they've got dental chairs and all the x-ray machines and all that sort of thing. The cost and expense of moving is just too great. It's often called goodwill. So tenants tend to want to stay in their commercial premises much longer than the tenants of residential property want to stay in residential properties. Another advantage, I think, of commercial is that tenants tend to earn their income there. They want to have the place looking good so that their clients will be inclined to come again. So they've got a vested interest in this, and they will do things actively to improve the place. They'll call you and say, is it okay if I paint the building? They'll call you and say, is it okay if I renovate, if I modernize this or put new flooring in? Whereas I have yet to have a single residential tenant anywhere call me to say, hey, can I replace the carpet? Or can I paint the outside? Or can I put in a new flower bed or something like that? They just tend not to do that. So given that there are some of the advantages, let me talk about some of the perceived disadvantages of commercial real estate, because they're all related with the financing at their core. And if I can share with you today how you might overcome those shortcomings, then you've got a good shot of thinking or rethinking how you consider commercial real estate. So one of the challenges I get when I encourage people to consider commercial real estate is they say, yes, but, and there's always a but, yes, but the prices of commercial property are so much higher than residential. So let's discuss that. A typical house, the median house price at the moment in the United States is hovering around the $300,000. In some suburbs, a slightly upmarket home might be $500,000 or $600,000. It's creeping up a lot, of course, in the last year. Average residential real estate prices have gone up 31% in the United States, and the United States was by no means an outlier in this regard. It wasn't even the head of the pack. There were other countries where the increases for the last 12 months were even greater than 31%. So I think it's generally accepted that real estate has been on the rise around the world. It seems to be coupled with low interest rates, which is another universal phenomenon almost. And the other thing is that there's been a shortage of supply. You know, when we had the GFC, the global financial crisis around 2008, there really was a surplus of housing and loans were very easy to get. We had in this country what was known as no docs loan, which means no documentation required. Another form of loan similar was stated income loans. You didn't have to prove your income. You just stated your income. So you might state that your income is, say, $3 million a year and you're looking at buying a $4 million property. And the bank didn't really bother to check whether you really had $3 million of income. They didn't care because they knew that no matter how big a fool you were to pay $4 million for that building today, next year there'd be an even bigger fool to pay $5 million for it. So claiming that you had $3 million of income, who cares? As long as the tenant paid rent, you would sell it within a year or two and you'd make money and the bank would cash out and you would cash out and the next buyer would win too. And that, of course, worked for years. Everyone kept on making money and making money on it until, like a house of cards, the whole thing had to collapse. So there was a surplus of housing stock back then and there was an easy access to financing. Whereas now, with prices at this all-time high all around the world, as I've said, many people come to me and say, Dolf, surely you realize a crash is imminent. And a crash could be happening. It could have started just as I started recording this podcast. And now we're in a situation where by the time it's finished and I check the news, I'm going to find out that the crash has happened. But I don't think it's going to happen, folks. And I don't think so for a very specific reason. What's different today is there's not a surplus of housing stock. There's actually a chronic shortage. Right now, it's estimated that there's a shortage of 4.1 million housing units in the United States alone. And this is similar to what we've got going on around the world. And it's not going to be alleviated anytime soon because, as some of you will have heard, there's what's called a supply chain crisis going on. It's difficult to get goods shipped around the world. There's a chronic shortage of microchips, not that that affects housing so much, of course, but there's a shortage of everything, lumber or timber. There's a shortage of iron for steel I-beams they use in construction. There's a shortage of windows. There's a shortage of just about everything. So it's not as if that's going to help overcome this chronic shortage of housing stock that we're facing at the moment all over the world. And for those reasons, I think prices will not only remain high, but will continue creeping up. Will there be a crash eventually? Yes, you've often heard me say that if you predict that the market's going to crash for long enough, one day, eventually, you'll be proven to be right. And you can say, see, I've been predicting this for 7 years. For 7 years, I've been saying it's going to crash, and hallelujah, it did. And I say the hallelujah not facetiously, because usually these people make their money by making predictions, not by buying or selling housing stock or real estate stock. So they are basically selling their predictions. And by the way, I've got quotes from magazines which say that, the era of rising housing prices is coming to an end and buying a house as an investment is no longer the golden egg that it's always been or something like that. And that came from magazines like Time Magazine or Business Week or Science Digest going back to 1947. So the pundits have been predicting this, and I don't blame them. Part of magazines and newspapers' task is to make predictions, and they sell their product, which is information, when they have sensational headlines. I'll never forget when I was living in San Diego. There was a headline in the San Diego Tribune, and I remember it. It said, cadaver found on beach, right? So body found on beach. And that was a sensational headline, I think. And even I was inspired to buy a newspaper. You can tell it was quite a while ago because I haven't bought a newspaper in decades. But on further reading, when you get into the actual article, you hear that it was a whale body that washed up on the beach. And suddenly you think, it was a whale body. I mean, sad for the whale, of course, but it wasn't quite what we thought. I mean, the inference was, and I think this is the slant they used to lure readers in, is that it was a human body that was washed up. So it's the nature of publications to have headlines that attract people. And listen, I don't blame them for that. When I write books, and I've written more than one or two of them, you want a headline, a title that is going to be catchy, because they say that about 50% of the sales of a book are based on either the headline of the book or the cover design, not even the content. And when you think about it, that's quite a scary thing, but it seems to be the reality. In fact, someone wrote a book on real estate. I don't know who it is. I haven't bought it, I haven't read it, but I love the title. I wish I'd thought of it. And the title is My Dad Thinks I Rob Banks. That's a great title for a book. It's catchy. So you want to have a great title. So do newspapers. I don't blame them for saying that the era of rising real estate values is coming to an end, because if they had a headline, wouldn't even be a headline, it would be a sub-paragraph on page 26. But if they had a headline that said, the average increase in real estate values around the country, including inflation, is about 9.7% per year. And this year, it seems we won't be far off it. It's continuing the trend that's been around for about 100 years. No one would buy a newspaper on that basis, right? And the same for these pundits who predict doom and gloom. They sell their prophecies because people want to know, they want to be prepared. So given all of that, despite all this talk and the questions I get about when is the market going to crash, I don't actually think it's going to crash in a hurry. I really don't think so. I think we're in for a good long run. So that question aside, they say it costs a lot more money to buy a big commercial real estate than the average home. Average price of a home, median price about $300,000. Commercial real estate, gosh, a tower like this, I don't know, 200 million probably. And by the way, I'm not in the market for buildings like this unless there are extraordinary circumstances, because usually a big glass and concrete tower like this that might sell for 20 or 30 or 50 or 200 million, the returns on those tend to be quite low. I haven't yet figured out a way of making them work. And even if I could figure out a way of making them work, for instance, let's say the return is 3% and I can borrow the money at 2%, the fact that I probably need a down payment, 10% of 200 million is still 20 million, and I don't have 20 million in the bank, so how am I going to do it? Now, there are ways of doing it, though, with smaller commercial buildings where you don't need, a lot of cash. So let's talk about loan to value ratio. Sometimes they're called LVR, loan to value ratio. Sometimes it's called LTV, loan to value ratio, depending on which part of the world you're in, but it boils down to the same thing. They are referring to how much of the purchase price is a bank willing to lend you when you acquire a property. So we all know that in the residential real estate world, typically banks will lend 80% of the purchase price. Now, in the United States, they will lend you more, but if you do borrow more, like 90%, you have to get what's called PMI, which I believe stands for personal mortgage insurance. That's insurance such that if you, for whatever reason, fail to meet your mortgage obligations, the P&I payment, the principal and interest payment for that month, the insurance will kick in and pay it for you. So you can get a 90% loan under extenuating circumstances, but you need PMI. By the way, if you think that's unlikely, let me tell you, you've been able to get 95% loans in this country, 100% loans, 105. The highest I've heard of is 115%. You probably think now I'm speaking out of school. If you think that's dramatic, I lived in the Netherlands in a period when they were offering 125% mortgages. And let's be very clear what we mean by that. That means if you're buying a property for $100,000, of course over there it would have been euros or at the time guilders, but for 100,000, the bank would lend you 125,000. Now, the inference is in these loans that you spend the surplus, the 25,000 surplus, on making an improvement to the home, because then, firstly, the value of the home goes up, usually by more than the 25,000 you spent on it, which means the bank security, the collateral they hold with the mortgage over the property, that's increased. And usually when you buy a house, you can't just move in. It's not move-in ready. You don't like the color of the carpet. You don't like the design of the wallpaper, assuming the house had carpets and wallpaper. No, walls might have been painted, but then you didn't like the color of the paint, or you needed new faucets or whatever. So that was the idea. So the idea that banks easily lend 80% and sometimes more if you're willing to pay PMI, that's not out of the ordinary. However, and this is what people use as an argument against buying commercial real estate, the LTV that banks will lend on commercial real estate tends to be a lot lower. It tends to be around 50%, if you're lucky 60%. I've had one at 66%, and on one rare occasion I got a 70% commercial loan, but typically it's 50 to 60%. So my detractors of commercial real estate will say, Dolf, how can you even talk about buying commercial when in general the prices are a lot higher? And secondly, the bank will lend a much lower proportion of the purchase price. Therefore, we need more cash. We don't have the cash. How can we do it? Well, to answer that question, I've got to get into the details a bit of how residential and commercial real estate work. And we all know that when it comes to residential property, there's a formula that people use to share how good the property is doing. And the formula is basically that the return or the yield, sometimes it's called the ROI, the return on investment, equals by definition the rental income divided by the purchase price. So let's say you've got a property, let's keep the number simple. You've got $10,000 a year of annual rental income and it costs $100,000 to buy. Your return is 10%. And you've got to ask yourself, who determines the market rent? Can the landlord just say, you know what, I'm short of cash this month. I think I'll charge $5,000 a month. When other similar houses are renting out for $1,000 a month, of course not. He can only charge $1,000. If he goes above market, no one will be interested. So the market determines the rent. And then similar question comes as to the purchase price. Who determines the purchase price of that property? Can a seller say in a market where houses go for $500,000, you know what, I want to get $2 million for that. So no, if he puts a $2 million price sticker on a home where every other home in the street sells for $500,000 and it's essentially a similar kind of home, then he's not going to sell it. So the market determines the purchase price. So if the market determines the rent and the market determines the purchase price and the ROI is the rent divided by the purchase price, then the ROI is also determined by the market. And that's why we'll often say that in this part of town, returns tend to be 6.5%. And that's just because the market has determined it and that's what it goes for. So when you go to buy a residential property, you effectively have to pay market price. Let's now switch gears and talk about commercial real estate. Because in commercial real estate, the formula is different. And trust me, if you can understand this and if you can follow this, then you'll be able to apply it. And if you can apply it, you'll make good money in commercial real estate. And the formula is that the value of a commercial building equals the rental income divided by the cap rate. And I know some of you are saying, aha, I knew there was going to be a trick. Here's a word I don't understand. Listen, it's really simple. Cap rate is short for capitalization rate. It literally means the rate at which you capitalize the rental income to arrive at the value. So let's put some numbers to it. It's a commercial building. Let's say the rental income is $100,000. And let's say cap rates are 10%. If you divide $100,000 by 10% or 0.1, you end up with $1 million. So if this property is generating $100,000 in rent and cap rates are 10%, then investors are willing to pay $1 million to buy that $100,000 of income because over 10 years, they'll get their $1 million back. That's how the formula works. So let's do the same thing. Let's ask who determines the cap rate. Well, the cap rate is determined by the market. You can't choose your cap rate. So if you can see that all these buildings are selling at a return of 10%, that means that investors are willing to buy with a cap rate of 10%. They'll pay 10 times the rental income to acquire that rental income. So then let's see what determines the value. The value is the rent divided by the cap rate. The cap rate is determined by the market. Let's say that we have a thrift shop as a tenant. Thrift shops are known for not making a ton of money. They're not a high-end boutique store that sells with a 300% markup or whatever, like a fancy bag shop, Louis Vuitton, Chanel, or Prada, or something like that. And they might sell a bag for $2,000. You know that there's a massive markup. Thrift shops tend to rely on donations and they send them at a low price. And let's say they were paying $12 a foot rental income and they decided not to renew the lease. You could advertise for a new tenant. Of course, you could advertise for a new tenant at $12 a foot, or you might go for an increase of $1 or $2 a foot, bring it up to $14 a foot. But you know that coffee shops are very popular right now. They're in demand. People go to a coffee shop. I was downtown just yesterday and I saw a plethora of shops that were open but had no clients in them. And across the road was a coffee shop and it was humming along. So they just do well. And they pay a much higher rental per square foot. So let's say you can get a coffee shop in at $24 a foot. I know of coffee shops paying $30 a foot and right now $36 a foot. So $24 a foot isn't out of the ordinary. So at $24 a foot, that would be double the rental of what the thrift shop was paying. So if the thrift shop were the tenant paying $100,000 a year and at a 10% cap rate determined by the market, the value of that building was $1 million. But if we managed to get a coffee shop in there willing to pay $24 a foot, that means their rent would be $200,000. Now, the cap rate doesn't change. The cap rate's determined by the market. Investors generally are willing to pay whatever the cap rate is. So in this case, 10 times that rental income to acquire the property. The value is 10 times the 200,000. So the value has jumped from 1 million to 2 million by switching out a tenant, a thrift shop at $12 a foot and replacing it with a coffee shop that's willing to pay $24 a foot. So who determines the rent on a commercial building? Well, it's whatever you can get in there. If there's a supply and demand for coffee shop space at $24 a foot and the lease on the thrift shop has expired, you can't kick them out before the lease has expired unless they willingly go and you want them to go, and you get them in at $24 a foot, the value has gone to $2 million. So here's a proposition I want to put to you, and I want you to think about this seriously because to me it's a really exciting aspect. Let's say you find this commercial building and it's got a thrift shop in it and they're paying $12 a foot. And let's imagine cap rates at 10%. On another occasion, we'll talk about how cap rates change and how they change with the market and what does a falling cap rate mean and what does a rising cap rate mean. Because once you get these things, you'll be able to buy commercial building after commercial building. So let's say you found this commercial building. It's got 6 months to run on the lease. They've got a thrift shop as a tenant. They're paying $12 a foot. And you know that the lease is expiring, you could buy that building, commit to buying it for $1 million. Remember, the price is $1 million because it's 10 times 100,000 income. And then finagle away to wait and then hope that you can get a new tenant in at $24 a foot. But I think you'll agree that's difficult. How do you pay for the building in the meantime? And what if you can't get the tenant in? But here's what I would do. I would start looking for a tenant. And, you can advertise or talk with people you know or go to existing coffee shop chains. Are you interested in this location? And if they say, yeah, we are, or we would be, what's the deal? You can say, well, listen, and just be honest, guys. You don't have to pretend you own the building. You say, listen, I know this building's for sale. I'm willing to have a crack at buying it, but I need a better tenant than what they've got there. If you're willing to sign a heads of agreement where subject to me buying this property, you will become the tenant, then I'm willing to have a crack at buying it. So let's say that all falls into place, then eventually you can have a contract on the building to buy it. And remember, you're committing to buy it for $1 million because that's what it's on the market at, because that's what the rental is. And then sometime between committing to buy and settlement, and if 3 months have already passed, then you're 3 months down the track. The thrift shop only has 3 months left on their lease. You just need settlement 4 months out. And in the meantime, you swap out that tenant. The lease expires, you don't renew. I'm assuming they don't have a renewal clause in this lease agreement. And then you get this new tenant in, and then you go to the bank to get funding on the basis that you've got a $200,000 a year tenant. And if cap rates haven't changed, and they're very slow to change, by the way, still be 10%, the building will now be worth $2 million. And if the bank says, well, we're only going to give you a 50% mortgage, 50% of 2 million, I'm sure you've worked that out already, it's 1 million, which is the purchase price. All right. Now, I know there are some subtleties that we don't have time to go into in too much detail yet, but just to head off some of the calls that I know are going to come from this, and that is that often banks say they take the lesser of the purchase price or the appraisal. Now, in this case, the appraisal is $2 million after we get our coffee shop tenant in there, but the purchase price is only $1 million. And you might say, fairly, how do you overcome that, Dolf? And the reason why banks have this clause in there is, let's say there's no change of tenant. And let's say that you can buy a building, we'll use different numbers, for $500,000, and the appraisal comes in at 580. You might think that you should get half of 580, which would be what? 40 is 290,000, whereas they say, no, we're only going to give you half of 500,000. That's where it comes to a quibble. They are a bit scared. They think, yeah, the appraisal might have been 580. It may have been a bit high. We're going to take the lesser of those two. However, in the situation we're talking about where we swapped out a tenant, it is a different building when we have the coffee shop in there than when we have the thrift shop in there. It's not literally a different building, but it's a different scenario. Yes, we paid $1 million for it, but that was then. That was when the thrift shop was the tenant. We have a new situation now. We've got a new tenant, a different tenant, paying twice as much rent. Surely, Mr. Bank Manager, you'd have to agree that this property is now worth a different amount. And most of them will go in and reluctantly say, you know what, it's true. That was then, this is now. And it manifests in all sorts of ways. I once bought a building that was empty. And I got it for a song because it was empty. Now, you can bet your bottom dollar that I didn't buy the building without knowing who my tenant was going to be. Of course I knew that. Right? So I bought it empty, and then I already had a tenant lined up. The tenant moved in. They were paying $30,000 a year. I went to the bank and I said, Mr. Bank Manager, I admit that when I bought this property, it was empty, but I do have a tenant now. So the price I bought it for was based on it being empty, and the appraisal I got using your bank-approved appraiser is based on having a tenant at $30,000 a year. Surely you agree and realize and recognize that it's worth a lot more than it was when I bought it. And the bank somewhat reluctantly said, yes, we guess it is. So they gave me money based on the new value. All right. So what I've done is I've gone over how you can overcome this massive objection to commercial real estate that A, it costs more in general to buy a commercial property. Not always. My cheapest commercial deal ever was $42,000. And by the way, it's been tenanted every day since I've owned it. Right, so $42,000 bought me a commercial property. Are they like that for the picking? No, but it is possible. You don't have to start with a multi-million-dollar building. And secondly, I concede it's true, banks tend only to lend about 50% of the appraisal on a property. But if you get a tenant in and you change the value of that building, they should lend 50% of the new value, and that may cover your purchase price. In fact, you can even put money in your pocket this way. But I think this is a good thing to whet your appetite, and I haven't run out of things to share with you on this aspect of how you can creatively fund commercial real estate. So maybe in my next podcast, which won't be from here, I will share with you how you can do that. Oh, and I said at the beginning that I would show you the view. So with that, I'm going to stand up here, grab this camera, and show you the view of the skyline here in Chicago. It's quite a stunning skyline. I'm right in the heart of it. I don't know how much glare is on the window. Probably a lot because the lights are on here. Just to give a bit, if I bring the camera up close, the glare will be gone. Anyway, that's what the skyline looks like. Sirens that I can hear down below and all. Thank you so much. I look forward to seeing you next time again. Bye-bye.